Hey everyone, it's Hamish Hodder here and welcome back to the channel. In today's video, we're going to be having a look at Texas Roadhouse and their Q4 and full year earnings for 2018. Now, this is a company that I've been looking at quite a lot recently, and we spoke about it in one of our podcasts actually for the main section of the podcast. If you want to check that out, I'll leave a link to it down in the description below. But today, so a couple of weeks ago actually, they released their earnings and I never got around to making a video on it, so I thought I would make it now and sort of get it out there. So we're going to talk about their Q4 numbers, we'll talk about their full year numbers and sort of how the growth has been compared to their long-term growth, and is their sort of growth continuing to go up, or is it leveling off, or what's happening there within the company. And then I'll talk about some things that were mentioned in the conference call. That there was a couple of interesting things that were mentioned there. And yeah, that's what we've got for today. So if you do enjoy the video, make sure you leave a like and let me know your thoughts on this company down in the comment section below. I will be having a discussion with you guys down there after the video goes live. So make sure you drop a comment down there so we can have a chat. But for now, guys, let's jump into it. All right, so we'll very briefly go through the Q4 numbers and then we'll jump into the full year numbers because of course, I'm a long-term investor. I really don't care what happens quarter to quarter. It really doesn't tell us too much about what's going on. Full years are what we like to look at, and full years over many years, and comparing that to their long-term performance is what we like to look at. So anyway, fourth quarter 2018, they came in with revenue of $605.9 million, and that was up 11.2% year over year. So they're still growing very strongly in this quarter, and their strong growth has basically come from two different areas. The first is that they've continued to open large amounts of restaurants, and we'll talk about how many they opened in 2018 in just a second. And the other reason is that they've had increased traffic, and really strong increases in traffic. The amount of people coming through the doors and sitting down and eating at these restaurants. And of course, we'll talk about that in the full year as well. But then we've got earnings per share. How much did they earn on a per share basis? So for the quarter, they earned 42 cents per share, which was up 5.4% year over year. So the reason that this growth was lower than their revenue growth was because, of course, they had increased costs. And the main contributor to those increased costs was labor costs, so paying employees. And this has been a bit of a trend in the past couple of years for this company, and it's been hurting their margins. And in the conference call, this was mentioned a little bit, which is what we will talk about later. I've said that 3 times already. I need to stop saying it. But essentially, let's just get into the full year numbers so we can talk about some of these things and sort of analyze whether or not they're concerning or whether or not they're just short-term things that we can put behind us, and we can see if they're going to hurt the stock price in the short term so that we can make an investment and make a good return over the long term. So in terms of the full year 2018 numbers, they had revenue of $2.5 billion, which was up 11.5% year over year. So that revenue growth was in line with their revenue growth of the fourth quarter, and it's been in line with their revenue growth over the past 9 years actually. So this company has been very consistent at growing their revenue. On screen, I'm probably showing it right now. You can see that over the past 9 years, and even in shorter periods, over 7 years, 5 years, 3 years, and the 1 year, it's pretty much all around 11%, which shows that they're very consistent at growing the company via those two metrics that I just mentioned, via growing the number of stores, and the number of stores that they brought out into, or they created and added to the pool in 2018 was 28 stores, which is quite impressive. And the other reason is that they've had a lot more traffic. So in 2018, traffic was up 5.4%. And the metric we use for that is comparable restaurant sales. So this tells us how the sales have gone in comparable stores. So if we just zoom in on one store, what has the sales of that store increased by? And that has been 5.4%, which for the restaurant industry, if you don't know, that is very good. And it's been growing quite consistently. In fact, for the first couple of months of 2019, their comparable sales was 6%. So not only is it strong, it's growing as well. So there's a lot of demand for these restaurants, and people are consistently coming back and enjoying dining at these restaurants rather than other restaurants in their areas. In terms of earnings per share, their earnings per share came in at $2.20, and that's up 20% year over year. And this is stronger than their historical growth. So their historical growth has been about 14% over the past 9 years, and they've been able to ramp up their earnings by effectively cutting costs while they maintain their revenue growth. So the revenue growth, as we just mentioned, has been about 11% pretty consistently. But they've been able to consistently reduce their costs over that time, and the result is long-term EPS growth, earnings growth, has been 14%, and in the past year, it's been 20%, and you can see on screen that it's been increasing slowly over time, which is really, really impressive, and it's exactly what we want to see for a good investment. We then have equity and free cash flow left. So equity came in at 945 million, and that was up 11% year over year. And again, same as revenue, this is pretty consistent to what they've been doing historically, which has been between 9.5% and 12%. So that's excellent to see. Equity growth is essentially the core value of the business. It's what we could sell the business for if we just wanted to dismantle it, sell all our inventory, sell everything and pay down our debts. That's what would be left over for us. So that's good that that is growing consistently. And then we have free cash flow. So free cash flow was 197 million, and that's up 57% year over year. Now this is very strong growth. However, this growth varies year to year depending on how many restaurants they spend money building. So because they take operating cash flows from their operations of their other businesses, and they spend some of it in capital expenditure in order to build out more restaurants. And for that reason, it fluctuates depending on how many restaurants they bring out that year or the prior year. And essentially, we can look at a better metric to see consistent cash flow for owners. And the better metric is to take the free cash flow and just to add back the spending on new restaurants. So in other words, we're looking at the operating cash flow minus the spendings of capital expenditure just to maintain the business, not to grow the business. And I call that cash flow for owners. And we can look at this, and this was 280 million in 2018, and that's up 20% year over year. And you can see that this number has been a lot more consistent. It's climbed from 12% over the long term in the 9-year average, all the way up to 20% in the last year. And this is essentially how much cash is going to be returned to us as shareholders. And the way that this cash is returned to us as shareholders is in a couple of different ways. They can pay a dividend, which they do. They can buy back stock, which they do. And they can invest in new restaurants, which increases the cash flows of the business, which they do. So this is the money that is really going to be returned to us each year. And it's a number that we want to watch when we're making an investment as an indicator of how much cash we're going to get back from this company. So next we have the conference call, and there wasn't too much here that was quite interesting, but there was 2 points that I noted. The first is that there was a lot of questions about labor costs and about margins. And the CEO basically said, yeah, it's pretty hard to foresee how this is going to affect specific restaurants because it affects different restaurants in different states and in different areas, depending on the laws and depending on the unemployment rates in those areas, is how effective or how much the increase of labor costs will be for those specific restaurants. However, he did indicate that labor costs are expected to slow down in 2019, or at least flatten off in 2019, so that they won't continue to grow at the rate they have been. However, of course, as a long-term investor, this is something I don't really care about because labor costs, increasing and decreasing labor costs is a natural part of the economic cycle, and it's a natural part of the late part of the economic cycle. So it's nothing that's too surprising for me considering where we are in the economy, and it's something that will go down over the long term, and it won't have a material impact on their business and how much cash they can produce over the long term. So it's something I'm not too worried about. Now, the other thing that was interesting that was mentioned was about their Middle Eastern restaurants. So if you don't know how Texas Roadhouse works, they have restaurants that they own. So they build them and they operate them and they take the profits or the losses of those companies. But they also have a franchise model, which means that someone else, a franchisee, starts the restaurant, and Texas Roadhouse doesn't have any liability in terms of if that restaurant loses money. But if the company is profitable, then they take a royalty. And this is the situation in the Middle East. There's a number of restaurants going up there that have been put out by a franchisee. And essentially these restaurants have been performing really poorly. And these are for various political and economic reasons. And the CEO basically said, or it wasn't the CEO on the call actually, sorry, but one of the senior management actually said that the franchisee who built these restaurants and is running these restaurants in the Middle East is planning to build another 3 restaurants in 2019. So clearly that franchisee who lives in the area and understands the economic and political climate thinks that those issues are short-term and won't be long-term issues. And that franchisee clearly thinks that over the long term, the brand is going to have a lot of power in that area and that they're going to attract a lot more customers. So this is a great thing for Texas Roadhouse. As I said, it's a franchise, so it means that they don't take any losses if these companies are poor. But if these companies succeed, which they're bringing in 3 new restaurants, which means that it's likely they are going to be successful, then that's going to be beneficial to Texas Roadhouse in terms of the royalties that they receive from those restaurants. So I just wanted to finish this video by looking at the stock price and how that's changed over the past year relative to their earnings. So in terms of the stock price, it really hasn't moved too much, or it's moved up a little bit. It's moved up 8%, which I mean, I can't say that's a little bit. That's quite a lot actually, compared to a lot of businesses which have had a ton of headwinds in 2018. So that is impressive. But if we compare that to how much cash for owners grew by 20%. So if we compare the two, the price for the company grew by 8% and the cash that is generated by that company grew by 20. So that means that relative to the start of the year, the company's price looks a lot better than it was. However, that doesn't mean that it's necessarily undervalued. It could have been overvalued and now it's a little less overvalued, or it could have been fairly valued and now it's undervalued. And that is up to you to work out. If you calculate how much cash you can get back from this company and you discount that at a rate that you are happy to receive over the next 10 years, then you can work out whether or not this would be a good investment for you. So that's all I had for this video with Texas Roadhouse. Just a quick one in order to go through their earnings and talk about some of the things that are happening with this company. I will definitely be making more videos on this company in the future, so stay tuned for that. And if you want to see more of those videos and you want to be notified when those videos come out, then make sure you hit subscribe and hit that notification bell so you don't miss out on any of the future notifications. But for now, guys, I'll see you in the next one.